Welcome back to The Explainer. Today, we are putting on our detective hats and stepping right into the shoes of a financial auditor. We're going to demystify exactly how corporate financial verification works, focusing specifically on how auditors scrutinize corporate loans. If you've ever stared at a massive number on a corporate balance sheet and thought, wait, how does anyone actually prove this money exists? Well, you are in the exact right place. Let's dive in. So, seriously, how do you actually prove a corporate loan is real? Because when you really think about it, a balance sheet is, well, it's just a piece of paper. It's simply a claim made by a company's management. And until an auditor actually comes in and verifies that information, it's just a heavily formatted promise. Our goal today is to look at the exact step-by-step procedures an auditor follows to transform those management claims into hard, verified financial facts. Here is our roadmap for this investigation. We've got 6 core audit procedures, and they make up the ultimate detective toolkit to catch financial misstatements. We'll be walking through existence, rights and obligations, cutoff, completeness, valuation, and finally, presentation and disclosure. Okay, first things first, let's define our terms. Under the rules of the Companies Act 2013, specifically Part I of Schedule 3, the word loans is kind of a broad umbrella. It doesn't matter if a company is lending money out for a decade to a subsidiary or just handing out a quick 1-month short-term advance. It all falls under this exact same umbrella of strict scrutiny that we're about to explore. All right, step 1 in our audit procedure, existence. Literally asking, does this money actually exist outside of the company's imagination? To prove a loan actually exists, the auditor first gets their hands on separate schedules for both long-term and short-term loans and advances. Then they verify if the balances shown in those schedules actually match up with the respective ledger accounts. But, we don't just trust the internal books. The auditor goes straight to the source. They try to get direct written confirmation from the very people or entities who are granted these loans. And it goes deeper. If the company is claiming advances against, say, insurance companies or railways, the auditor has to examine all the related correspondence to ensure only admitted claims are shown. No wishful thinking allowed. Finally, they pull copies of statutory returns, like IT and GST returns filed with the authorities, just to verify that the amount recorded in the books perfectly tallies with the claims actually made. Moving right along to our second pillar, rights and obligations. Because it's not enough to simply prove that a loan exists, we have to figure out who actually holds the power.
The absolutely crucial point here is that every single loan must have a strict foundational authorization. The auditor checks to see that these loans and advances are authorized by the company's ultimate rulebook, its memorandum and articles of association. And listen to this. The guidelines explicitly state that auditors must be extra cautious when verifying the authorization for related party loans and advances. You definitely can't just lend corporate money to your friends or subsidiary companies without rigorous documented authority.
Now, the type of loan really dictates the specific checks an auditor has to do. For example, if it's a secured loan, they have to physically verify the mortgage deed to check the terms and conditions. If it's an unsecured loan, well, they must judge the actual possibility of its recovery, which can be a tough call. And what about internal money, like advances granted to employees? The auditor doesn't just take management's word for it. They actually examine the payroll to ensure those loan installments are being regularly deducted from the employees' salaries. Okay, once we know the loan is real and authorized, we hit procedure number 3, cutoff. And in the financial world, timing isn't just a minor detail, it is absolutely everything. So, cutoff procedures basically draw a hard chronological line in the sand. The auditor has to ensure that the value of loans shown in the balance sheet comprises all loans given by the company and that they were outstanding strictly on the reporting date. We can't count loans that were settled 3 days before the year ended, and we definitely can't sneak in loans issued 2 days after. The balance sheet is a snapshot in time, and this procedure ensures the camera flash went off at the exact right millisecond. Which brings us nicely to step 4, completeness. Our financial detective has to ensure nothing has been conveniently left off the books. Now, what's really fascinating about completeness is the dual responsibility it places on the auditor. Not only do they have to see that all the loans and advances outstanding on the reporting date are fully recorded, but they also have to ensure that all the money recovered against those advances has been appropriately recorded against the respective advances. It's a two-way street, right? You can't just record the money you pushed out the door. You have to meticulously track and apply every single penny that walks back in. All right, let's step into the 5th phase, valuation. This is where things get a bit more subjective, shifting from tangible dates and ledgers into assessing a loan's true realistic worth. To figure this out, auditors rely heavily on an aging schedule. They'll obtain a schedule breaking down the different loans, alongside a specific list of any loans that are currently locked up in litigation. And they don't just look at the current year in a vacuum either. They verify the previous year's estimate of doubtful loans, they actually sit down for a discussion with management, and they verify the adequacy of the allowances for doubtful accounts for the current year. They're essentially asking the hard question. Based on how long this money has been sitting out there, how likely are we to actually get it back? But what happens when a loan goes completely bad? Well, it can't just be quietly deleted. The auditor has to assess the movement of bad loans to the provision account, or as write-offs, and they must strictly see to it that any write-offs are properly authorized by a responsible official. Basically, you need a rock-solid paper trail of accountability anytime corporate assets are officially declared lost. And finally, we arrive at our sixth and last audit procedure, presentation and disclosure. This is the final verdict, where all that investigative work gets formalized for the public record. The Companies Act 2013 is highly specific about how this information has to be presented. For a company, the auditor must ensure that loans and advances are strictly categorized under non-current assets and current assets, specifically using the subhead loans, exactly as per Part 1 of Schedule 3. But checking the balance sheet isn't the end of it. The auditor also has to ensure that all relevant information regarding these loans is fully and transparently disclosed in the Notes to Accounts section. So we've walked through existence, rights, cutoff, completeness, valuation, and finally disclosure. It is a wildly rigorous, demanding process. So I leave you with this thought. After seeing the incredibly strict scrutiny that corporate loans must undergo, will you ever look at a simple number on a corporate balance sheet the same way again? Next time you're skimming through an annual report, remember all the financial detective work happening behind the scenes to verify every single digit.
Okay, today we're jumping straight into the rigorous, step-by-step investigation that auditors use to verify a company's financial claims. I mean, we hear all this talk about record-breaking corporate revenues and massive balance sheets, right? But how do we actually know that the money a company claims it's owed is, well, real? The answer lies in a highly structured audit process, and we're going to break the whole thing down. So, let's frame this by thinking of our auditor as a financial detective. Imagine you're tasked with proving that a giant mountain of corporate IOUs actually exists, that it's legally binding, and that it's genuinely worth what the company claims. You know, this isn't just glancing at a spreadsheet. It's about digging deep and uncovering the real financial truth behind those numbers.
First things first, we need a baseline definition. What exactly are we investigating here? Basically, a trade receivable is strictly an amount due on account of goods sold or services rendered in the normal course of business. It's specifically that amount recoverable from customers. Think of it as the lifeblood of day-to-day operations. It's money expected from actual legitimate sales, not from side deals or special favors. Which means we have to immediately separate everyday customer IOUs from other types of financial claims. If a company hands out a cash advance to a supplier or maybe a loan to an employee, well, that absolutely cannot be included under the head of trade receivables. Our detective work here focuses purely on revenue generated from standard daily business activities.
To verify these receivables, the auditor investigates 6 key areas: proving the existence, rights and obligations, the cutoff question, completeness, valuation, and finally, presentation and disclosure.
Let's kick things off with Step 1, proving existence.
So the auditor first has to prove these debts aren't just phantom numbers pulled out of thin air. They don't just take management's word for it. Instead, they demand a schedule of debtors duly signed by a responsible officer. Then, they roll up their sleeves and check how those balances agree with individual ledger accounts. They pay really close attention to the age of the debts, like, has the age been properly determined? Are the outstanding amounts actually in line with the entity's standard credit terms? They even check to make sure any transfers between accounts are properly evidenced. It is a meticulous, line-by-line verification. Moving right along to Step 2, rights and obligations. Because hey, just knowing the IOU exists on paper isn't enough. Does the company actually have a legal right to collect that money? Ownership is absolutely key. The auditor has to make sure the company has valid claims to the amounts shown as debtors. This literally means physically examining the bills and notes receivable to see if they are legally held by the company. If the claim isn't legally binding, it simply doesn't count. Step 3 is what we call the cutoff question.
This step is all about timing. A genuine claim recorded on the wrong day can completely distort a financial statement, so the cutoff rule is incredibly strict. The receivable balance must represent the sundry debtors held by the company on the reporting date only. If a massive sale happened at, say, 8 a.m. the morning after the reporting date, it gets entirely thrown out of this year's investigation. Timing is everything, and our detective ensures those fiscal boundaries are respected.
Next up, Step 4, completeness. Here, the auditor has to ensure they're seeing the whole picture, that the company hasn't swept any bad news under the rug. So they frequently go completely outside the company. In case of a dispute, they'll get direct confirmations from the debtors themselves. But they go further. They dig into legal files, inspecting court orders declaring a debtor's insolvency, or reviewing correspondence with lawyers about bad debts being written off. And as a final reality check, they verify subsequent realizations. Basically, they check the bank statements after the reporting date to see if the cash actually arrived.
That brings us to Phase 5, the valuation test.
Okay, the IOUs might be real and legally binding, but this asks the most painful question. Will the customers actually pay what they owe? $100 million in receivables is worthless if the customers are bankrupt, right? So auditors recalculate the provision for bad and doubtful debts, comparing it against past periods to see if the estimates are actually reasonable. They also verify discount calculations on bills and heavily investigate any excessive rebates allowed beyond normal terms. Plus, every single bad debt written off gets examined to make sure the valuation is grounded in harsh reality, not blind optimism.
And finally, Step 6, presentation and disclosure.
The auditor has to make sure all this verified data is presented to the public following strict legal formatting, specifically Part 1 of Schedule 3. Trade receivables can't just be one giant opaque number. They have to be explicitly subclassified. First, secured, considered good. Second, unsecured, considered good. Third, and this is where the red flags show up, receivables with a significant increase in credit risk. And fourth, credit impaired. This breakdown is brilliant because it exposes exactly how much risk is hiding in that pile of IOUs. Oh, and any allowance for bad and doubtful debts must be disclosed separately under the relevant heads too.
Now, this part is crucial for preventing insider games. If the company is lending money to its own directors, its officers, or private companies where a director is a partner, it cannot be hidden in the general pile. It absolutely must be separately stated. This ensures that any potential conflicts of interest or insider borrowing are instantly visible to the public.
Furthermore, under these Schedule 3 requirements, companies are forced to publish a strict aging schedule for their outstanding trade receivables. This forces them to reveal exactly how long these debts have been sitting unpaid, categorized all the way from less than 6 months to more than 3 years. This instantly highlights if a company is sitting on a mountain of old uncollectible debt that it's desperately trying to pass off as a current asset.
Ultimately, walking through this 6-step explainer shows us exactly why the auditor's rigorous detective work is so vital. It is literally the only thing standing between financial truth and corporate fiction. So the next time you see a company reporting massive record-breaking revenues, you really have to ask yourself, until the financial detectives have done their work, how much of that wealth is real and how much is just a mirage?
Today, we're taking a look at how auditors act as financial detectives to verify a company's most liquid assets. We're going to break down exactly how these professionals confirm that the cash a company claims to have is actually sitting there, ready to be used. I mean, cash is literally the lifeblood of any business, right? So verifying it requires a very specific and highly rigorous mindset. So imagine a company puts out a shiny balance sheet and says it has millions in the bank. Sounds great, but how do we actually prove it? We simply can't take management's word for it. We need concrete, verifiable evidence. And that's exactly the core problem we're tackling today, moving beyond claims and uncovering the hard truth. Here is our investigator's roadmap for this explainer: defining liquid assets, proving it actually exists, rights and ownership, timing and completeness, valuing foreign currency, and finally, presentation and disclosure. Let's get to it. Okay, step 1, defining liquid assets, knowing the target.
Now, when we say cash, we're not just talking about stacks of bills in a register. The whole shebang actually includes physical stamps, checks in hand, balances in current accounts, debit balances in cash credit accounts, and even fixed deposits or margin money accounts. Basically, we're looking at short-term, highly liquid balances that form the absolute baseline of a company's financial reality.
And check out this phrase right here, utmost professional skepticism. This is absolutely crucial, Because cash is so highly liquid and, let's be honest, so easily manipulated or stolen, an auditor just can't be complacent. Professional skepticism means having a questioning mind. You're constantly on alert for evidence that contradicts what management is telling you, and you are rigorously evaluating the reliability of every single document.
Moving on to Step 2, proving it actually exists, the core investigation.
So, how do we prove it's actually there? Well, Step 1 is a literal surprise visit to physically verify the cash on hand. Bam, show me the money. Then, for Step 2, we dig into the rough cash book. If an auditor finds some random slip for a temporary advance given to an employee that's been sneakily included in the cash balance, yeah, they're going to require a responsible official to sign off on that immediately. And Step 3 is the big one, securing bank reconciliation statements signed by the accountant, and directly contacting banks to get independent, written confirmation of all balances to rule out any errors.
To dig even deeper, we do a cash sensitivity analysis. You calculate month-wise receipts and payments to spot abnormal variations. Just look at that massive spike in month 2 on the chart. There's no way you can just brush past that. When an auditor sees an anomaly like that, the skepticism kicks into high gear. They are going to immediately march up to management and demand a logical, documented explanation.
Step 3, rights and ownership. Whose cash is it anyway?
You know, it's one thing for the cash to exist. It's another entirely to prove who actually owns it. You have to pore over those banker confirmations and certificates of deposit to absolutely verify that all holding rights and legal obligations belong entirely to the audited company and not some random third party.
Step 4, timing and completeness, drawing the line.
This slide really hits the nail on the head. Cutoff is drawing a hard line in the sand. If the reporting date is March 31st, the cash balance has to reflect that exact day, not April 1st, not March 30th. Completeness, on the other hand, guarantees that absolutely every single account and physical cent is accounted for. The auditor has to get 100% confirmation of all bank accounts to ensure no obscure account or loose cash is left off the final reported balance.
Step 5, valuing foreign currency, exchange rate reality.
For international companies, things get a little trickier. You can't just use an average exchange rate from 6 months ago, right? Exchange rates fluctuate literally every day, so you have to identify every single bank balance holding a foreign currency and meticulously restate them. And you must apply the exact exchange rate prevailing on the strict date of reporting to get a true and fair view of its value.
And finally, Step 6, presentation and disclosure, the final report. At the end of the day, you can't just lump all this into one giant bucket called cash. The auditor has to make sure all disclosures strictly comply with the relevant accounting standards and Part 1 of Schedule 3 of the Companies Act 2013. As you can see in this table, it's all about meticulous categorization to ensure absolute transparency for the public and the shareholders. So that is the playbook for verifying cash. It is intense, right? Thanks for joining me to unpack this whole process. But I want to leave you with a final thought to ponder here. If auditors have to go to these extreme lengths and apply this much skepticism just to verify a company's most easily accessible asset, what kind of hidden secrets do you think they're hunting for in the rest of the balance sheet?
You know, when we look at a massive public company, it's super easy to get distracted by the shiny products and the glowing marketing campaigns. But beneath all of that, well, that's the structural foundation of the company itself, its share capital. Today, we're going to look at this through the eyes of an elite financial detective, the auditor. It is literally their job to tear into the very fabric of a company's funding and verify that the foundation is rock solid, completely legal, and mathematically flawless. Which brings us to a pretty massive question, right? When these public companies procure capital from the public, inviting applications and issuing shares, how do they actually prove that the money is there? Who checks the math? I mean, when millions of dollars are changing hands from public allotments to underwriter settlements, we definitely can't just take a company's word for it. The auditor steps in to apply a rigorous verification process to ensure absolute transparency. So, here's our investigation roadmap for today. We'll be looking at 1. The core of share capital. 2. Proving existence and rights. 3. Timing and completeness. 4. Calculating the true value. And finally, 5. The rules of disclosure. Let's jump right in. All right, Section 1, the core of share capital. Basically, every company's financial journey starts exactly the same way, with the procurement of capital. For public limited companies, this means inviting the public to subscribe to shares. They issue a prospectus, and once those applications roll in, they make allotments to eligible applicants, officially turning them into members of the company. And in this high-stakes process, companies often appoint underwriters to guarantee the issue. So, as our financial detective, the auditor must carefully examine every single one of these related aspects, from that initial prospectus all the way to the final public allotment. Moving right along to Section 2, Proving Existence and Rights. Okay, so the very first audit procedure is what we call existence. The auditor has to prove the capital actually exists, and they do this by reconciling the opening and closing balances of share capital. They're looking for any new issues, capitalizations, buybacks of equity shares, or redemptions of preference shares. But actually, they don't just stop at the numbers. If there's a change, they must verify that the revised capital is strictly within the limit of the company's authorized capital. And most importantly, they check the minutes of the board of directors and shareholder meetings. Every single transaction affecting share capital has to be genuine and properly authorized by a formal resolution, no exceptions. And that naturally brings us to the next crucial check: rights and obligations. Because it's not enough that the money is just there. It has to be there legally. The auditor ensures that any new issue completely satisfies all the regulatory requirements of the Companies Act 2013 and SEBI guidelines. Specifically, they act as a watchdog to guarantee that absolutely no shares have been illegally issued at a discount. And if shares are issued at a premium, well, the auditor verifies that the share premium balance is utilized only for permitted purposes. Furthermore, if the company issues sweat equity, rights shares, or bonus shares, the auditor is right there ensuring every single rule has been strictly complied with. Which leads us directly into Section 3, Timing and Completeness. Now, the crucial point about the cutoff procedure is temporal accuracy. The auditor must ensure that the balance of share capital represents exactly what it was on the specific reporting date. It literally cannot include transactions that happen a day late, nor can it omit transactions that happen a minute before midnight on that reporting date. It's a strict, hard boundary. Working hand in hand with cutoff is completeness. This is really the auditor's way of systematically verifying that every single change made in share capital hasn't just occurred but has been duly given effect in the books. They need to ensure that all accounting entries are entirely adequate and that absolutely nothing has been left off the ledger.
Next up, Section 4, Calculating the True Value.
So, in the valuation phase, our financial detective shifts from recording entries to verifying the hard math. They verify that the total proceeds collected are absolutely mathematically correct. They verify the calculation of all proceeds received and meticulously check how those proceeds are allocated to various accounting heads. But it gets a bit more complex. When a company uses underwriters, the auditor must also recalculate the underwriter's commission payable and verify the final settlement of their accounts against their liability. Calculating these values requires some truly rigorous attention to the books. The auditor has to verify the final settlement of underwriter accounts against their actual liability, ensuring that the calculation of total proceeds and the underwriter's exact commission payable are perfectly aligned and properly settled. It's like a giant, high-stakes puzzle where every piece has to fit exactly right. And finally, we arrive at the most demanding investigative phase in Section 5, the rules of disclosure. Part 1 of Schedule 3 of the Companies Act 2013 requires an absolute literal mountain of specific information to be presented to the public. And we've chunked down those massive requirements for you here. For every single class of equity shares, the auditor ensures the company discloses the exact number and amount of shares authorized, issued, subscribed, fully paid, and even those subscribed but not fully paid. They also must disclose the par value per share and provide a clear reconciliation of outstanding shares at the beginning and end of the period. Oh, and finally, they must clearly state the rights, preferences, and any restrictions attaching to each class of shares. It's a lot, but it's absolutely vital for transparency. Crucially, there's also a massive spotlight put on the major players. Auditors have to make sure the company singles out and discloses specific details, including the exact number of shares held for any individual shareholder holding more than 5% of the shares in the company. You definitely want to know who the heavy hitters are, right? Furthermore, this brilliant checklist dives even deeper into the company's future commitments and potential liabilities. The company has to reveal any shares reserved for issue under options, contracts, or disinvestment commitments, including the specific terms and amounts. They also have to list the terms of any convertible securities, tracking their earliest conversion dates in descending order. And the auditor ensures transparency at the executive level too by disclosing the aggregate value of calls unpaid specifically by directors and officers. Finally, They track the originally paid up amount of any forfeited shares and distinctly highlight the shareholding of the promoters. So from proving existence and legal rights to verifying cutoffs, completeness, valuation, and demanding exhaustive public disclosure, these procedures form an ironclad wall of accountability. It really leaves us with a profound realization about the rigorous work of these financial detectives. Think about it. If an auditor misses just one of these steps, if they fail to check a board resolution, miscalculate an underwriter's settlement, or overlook a critical disclosure for a 5% shareholder, the entire integrity of the financial statement is compromised. So the next time you look at a company's massive share capital figure, ask yourself, do you trust the number or do you actually trust the audit that proved it? Today, we're jumping right into a really fascinating and honestly super intricate area of corporate financial reporting. We are talking about auditing other equity under Schedule 3, Division 2. So here's the big question that's going to frame our whole journey today. How exactly do you audit the absolute most complex section of a balance sheet? Think about it. When a company is holding millions or literally billions in reserves, surpluses, and these wild, complex financial instruments, how on earth does an auditor untangle that massive financial web to make sure everything is perfectly legal and accurate? Well, let's trace that investigative narrative arc right now and find out. Okay, let's dive right in by setting up our scene of the investigation. What actually is other equity? Under Schedule 3, Division 2, other equity isn't just some random leftover dumping ground for extra numbers. No way. It's actually a highly structured, highly specific category, capturing a really diverse array of financial realities, everything from retained earnings to some serious market fluctuations. To really grasp the scale of what an auditor is looking at, we need to chunk out these elements. First up, we've got share application money pending allotment. So, money received before shares are officially handed out. Then there's the equity component of compound financial instruments. These are those tricky hybrid instruments with both debt and equity features. But the real heavyweight here, that's reserves and surplus. It's a massive bucket including capital reserves, securities premium, other reserves, and retained earnings. We also see debt and equity instruments tracked through other comprehensive income, or OCI for short. And it doesn't stop there. The complexity just keeps building. An auditor also has to track the effective portion of cash flow hedges, which essentially lock in future prices to manage risk, plus the revaluation surplus, when property or assets actually increase in their book value. Then add in exchange differences from translating foreign operations financial statements. Finally, wrap all that up with other items of OCI and money received against share warrants. It's basically a massive, constantly moving puzzle. Now, here's a crucial detail. Not all equity is created equal, and auditors have to police these boundaries incredibly strictly. Some of these sources are perfectly eligible to be paid out as dividends to shareholders. Sounds great, right? But others, they are strictly locked down. For instance, things like the securities premium and the capital redemption reserve absolutely must be utilized for specified legal purposes only. You literally cannot just dip into the securities premium to hand out a massive year-end dividend. It doesn't work that way. All right, Phase 1 of the investigation, verifying existence and rights. Before even looking at the complex math, an auditor has to prove two foundational truths. Number 1, does this money actually exist in the company's records? And number 2, does the company actually have the legal right and obligation to claim it? Auditing for existence is meticulous, step-by-step work. The auditor first traces the opening balances of reserves straight through to their closing balances. If there's an addition during the year, say issuing new shares at a premium or transferring current year's profit to the general reserve, they don't just take the company's word for it. They ensure these additions are 100% genuine and properly authorized by resolutions in the meetings of the board of directors and the members. Literally, every single reduction or addition needs a proven, valid transaction behind it. And that brings us right to rights and obligations. The auditor acts as a strict legal checkpoint here. They are verifying that the addition and utilization of these balances are in absolute compliance with the relevant act and regulations. If a company uses its reserves, the auditor has to verify that the utilization was for specified purposes only, exactly as the law prescribes. There is absolutely zero room for creative accounting here. So, with existence and legal rights firmly proven, we transition to Phase 2 of our investigation: cutoff, completeness, and valuation. This is where we close the technical loop to make sure the numbers are perfectly bound and mathematically flawless. Think of cutoff like a strict photograph in time. The balance of each item of other equity must represent the amount of share capital on the reporting date and the reporting date only, nothing from the day after. Completeness, on the flip side, is about making sure the entire picture is actually there. The auditor has to guarantee that absolutely all changes made in other equity items have been duly given effect and that every single accounting entry is fully adequate. Next up, we evaluate valuation. And this isn't just about confirming that a number exists. It's about deeply investigating the math behind it to ensure every single addition and reduction is calculated with absolute precision. It's basically the ultimate quality control for corporate mathematics. Let's ground this in a real-world scenario directly from the rules. Say a company decides to utilize its accumulated profits to pay a dividend to its shareholders, while the auditor steps right in to check the valuation. The amount utilized absolutely must legally satisfy the specific conditions laid down in the company's Declaration and Payment of Dividend Rules from 2014. The auditor is right there, recalculating and verifying that the company's math perfectly aligns with those statutory rules. Finally, we reach the end game, the final report, focusing on presentation and disclosures. You've verified the money exists, you've checked the legal rights, you've bound it by date, and you've checked the math. Now, how must the company show its work to the world? Well, this is completely governed by the strict disclosure rules outlined in Part 1 of Schedule 3 of the Companies Act 2013. These rules are incredibly strict about how things are classified in the notes. Other reserves can't just be some mysterious slush fund. They have to be explicitly broken down. You need very specific line items for the capital redemption reserve, the debenture redemption reserve, and the share options outstanding account. And for any others, well, the company must explicitly specify the exact nature, purpose, and amount for each reserve. On top of that, all additions and deductions since the last balance sheet have to be clearly shown under each specific head. All of this meticulous tracking comes together in the Statement of Changes in Equity, retained earnings, revaluation surplus, the equity component of compound financial instruments. Literally every single element we discussed earlier is meticulously tracked here across the reporting period, and the auditor's job is to make sure the entire statement is flawlessly populated. Because at the end of the day, total transparency is required, even when the numbers are bad. If a reserve is specifically represented by earmarked investments, that fact has to be explicitly disclosed. And here is a really fascinating rule. If the statement of profit and loss has a debit balance, meaning the company took a loss, it must be shown as a negative figure under retained earnings. Similarly, the overall balance of other equity, after adjusting for any negative retained earnings, must be shown under other equity even if the resulting final figure is in the negative. You simply cannot hide a loss by reclassifying it. In the financial report, the flow of money is strictly separated. Total comprehensive income for the year is separated from dividends, and it's separated from transfers to and from retained earnings or the general reserve. Every movement of value has its own distinct place. This ensures that any shareholder can see exactly where the wealth was generated and exactly where it was distributed or stored. As we wrap up this explainer today, I want to leave you with one final provocative thought. We've just walked through the incredibly intense, meticulous rules of Schedule 3, Division 2. We've seen how auditors trace every single balance, verify every board resolution, and police the strict boundaries of dividend eligibility. So, how do these rigorous, almost exhausting auditing boundaries ultimately protect you, the everyday investor? Well, they ensure that the financial health a company projects to the world is never an illusion, but a verified, legally compliant reality.
Today, we're putting on our detective hats to figure out exactly how auditors investigate and, well, interrogate corporate debt. Because when we look at a company's financial statements, those numbers don't just magically appear out of thin air. They are rigorously tested and verified. So we're going to look specifically at how auditors handle one of the most critical, high-stakes areas of any business, their borrowings. We'll see exactly what it takes to ensure everything is completely above board.
We've got a strict 5-part framework to get through. We're going to cover the basics of borrowings and then jump into the 5 key steps of the audit procedure: proving existence, checking rights and obligations, ensuring completeness, accurate valuation, and finally, proper presentation. Let's get to it.
First up, the basics of borrowings, understanding the suspect. So, what are we actually dealing with here? Borrowings are, simply put, the formal loans a business procures, and according to our source material, they generally fall into 2 distinct buckets. They are both long-term and short-term in nature.
The difference between the two is pretty straightforward, but absolutely crucial. Long-term borrowings are all about building for the future. They are procured for business expansion or for buying fixed assets. Think, buying a massive new manufacturing plant.
Short-term borrowings, those are mostly done for working capital financing. It's the everyday cash that just keeps the lights on.
Okay, step 1 in our audit procedure, proving existence. Basically, is the debt real? This is the auditor's absolute first question. Is this debt actually real, or is it just some ghost floating around on the books? You literally can't take anything for granted in this business. You have to prove it exists.
To do that, the auditor hits the ground running with 3 main steps. First, they collect a comprehensive schedule of all borrowings. Then they dig into examining the actual loan agreements. And finally, if it's a bank loan, they obtain direct confirmations from the bank regarding the outstanding amount just to tally it against the books.
And when they're looking at that schedule of borrowings, they aren't just skimming. They're meticulously verifying the exact date of procurement, the period of the loan, the interest rate, the principal amount, and any pledged assets. Plus, they have to ensure the loan is officially and legally taken out in the client's name. They literally tally the recorded loan right against the paper agreement.
Moving on to step 2, rights and obligations, or as I like to think of it, following the rules. Here's the big question for this phase. Did a rogue executive just take out a huge loan without proper board permission? We have to figure out if the procurement of the loan was actually properly authorized.
To verify that authorization, the auditor dives deep into the compliance checks. They examine the company's fundamental rulebooks, the Articles of Association and the Memorandum of Association. For a company, they're looking specifically for a resolution from the board to prove authorization. They also verify that all loan conditions are duly complied with, and they review the register of mortgage maintained by the client.
Now, as part of this, the auditor also collects a certificate from the lender about pledged assets. And they have to ask a vital question about the nature of the charge. Is it a fixed or floating charge? This is a big deal, because if an asset is pledged with a fixed charge, it absolutely cannot be sold without the lender's permission. The auditor is essentially hunting for any irregularities here.
Next up is step 3, ensuring completeness. In other words, are they hiding anything?
The detective work gets really intense here. Has the company concealed any active debt? Or, on the flip side, have they kept a loan that was already paid off in full shown as outstanding? The auditor has to make sure absolutely all the cards are on the table. So the auditor ensures that information regarding all loans has been produced before them, period. They double-check that the details about pledged assets and the nature of the charge are totally complete. And for any brand new loans taken out during the year, those get strictly verified against the minutes of the board meetings for proper authorization.
All right, step 4, accurate valuation. Do the numbers actually add up? Now it's time for the math. The auditor checks whether the accounting policies and methods of recording the loan are appropriate and consistently applied. They verify that the interest payable has been paid right on due time and accounted for properly. And if there's any outstanding interest, you better believe the auditor is verifying that too.
During this valuation, you'll often run into the term amortizing loan. It sounds like heavy finance jargon, but it just means loans where the principal amount is repayable in installments over time, rather than all at once. And for these amortizing loans, the auditor has a very specific job. They must strictly determine the current maturities of the loan. They need to know exactly what portion of that debt needs to be paid back right now.
Which brings us to our final phase, step 5, proper presentation, visualizing the balance sheet.
Everything has to go in its exact proper place. The non-current or long-term portion of the loan goes under non-current or current liabilities. Those current maturities we just talked about, the installments falling due within the next 12 months, those are shown under current liabilities, and they need a footnote disclosure. Plus, any restrictive covenants, the conditions attached to the loan, have to be appropriately disclosed in the financial statements.
All of this presentation isn't just a best practice, it's the law. Specifically, the outstanding amounts have to be shown under the subhead Borrowings, exactly as per Part 1 of Schedule 3 of the Companies Act 2013. The auditor also has to make absolutely sure that any charge on assets is appropriately reported right there in the balance sheet.
And guys, check this out. This is a massive gotcha moment. The source rules state that if the value of the pledged security falls short of the outstanding loan amount, the auditor has to examine if the loan is classified as secured only to the extent of the market value of that security. You literally cannot claim a massive loan is fully secured if the asset backing it has plummeted in value. Auditing corporate borrowings is intense, right? From proving existence with banks to hunting down board minutes to strictly following Schedule 3 for the balance sheet, it is a relentless, thorough process. So I'll leave you with this. The next time you glance at a company's financial statements, looking at all that debt, do you feel ready to put on your detective hat and interrogate those numbers yourself?